Welcome to the Big Mike Fund Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in. Because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fund Podcast. I'm the Big Mike Zlotnik. Today it is my pleasure and a privilege to welcome Sam Wilson. Hi, Sam.
Hello, Mike. How are you today?
I'm doing well. How are you?
Great, man. Can't complain.
Sam hails to us from Memphis, Tennessee, and Sam is an opportunistic real estate investor. He's invested into a broad range of asset classes, including self-storage, parking, multifamily, RV parks, single-family homes, and so on and so forth. He's also a host to a podcast called How to Scale Commercial Real Estate podcast. And so let's start by learning a little bit about Sam. Your family, I like to put it, wife's, kids, pets, cats.
Sure. Yeah. As you said, I live here in Memphis, Tennessee. I'm not a Tennessee native. My wife is, but I owned a business up in Indiana. We got married. I sold that. And then we decided to head south because we hate the cold. So, and Tennessee may even yet be still too cold for me in the winter, though winter is short, especially here in the Delta. But either way, yeah, married. I always joke. I introduce her as my first wife because that's who she is. We've been married for 11 years. We've got 3 foster kids at home, 5, 3, and 1. So it's a house full and all hands on deck there. A dog that found me in the woods. And yeah, that's the short of it, man. It's a house full and there's always lots of activity, but the kids right now probably keep us more busy than anything else.
Yeah, it's a great family. I know the drill. You got 4 kids and a cat, so you get pretty busy. That's great.
Yeah, absolutely.
That's great. So let's talk a little bit about real estate. Let's start. What do you like today? I mean, we are kind of recording this in early summer. We're dealing with a very inflationary environment. Everything seems to be doing well. Real estate is hot, but what do you see? What are the best opportunities going forward?
Yeah, it's a great question. I think everybody's asking that, Mike. And so, the only thing I can do is just say from my perspective, what we see as opportunity. I think anytime you're in an inflationary period, you want to be in assets that can be quickly repriced, right? You want hard assets that can be quickly repriced and pass that inflation on, in theory, on to the end consumer. So we own laundromats right now. That's a business I'm involved in, which, the repricing of self-service laundromats takes me about 15 seconds. So it's, sorry guys, our utility costs have gone up in the last year, 150%.
That's an extra quarter, right? Or whatever the charge is.
Yeah, exactly. I put 25 cents an extra on those machines and now you've paid for utility. And it's really, it gets absorbed by everybody and it's not that big of a deal. In the real estate realm though, looking at things, we've had some weird stuff going on. Obviously everybody's aware of the COVID problem. Of the eviction moratoriums and things like that. I am involved in multifamily, and luckily both my passive and active investments have fared fairly well in those environments, and we've not suffered too much from eviction moratoriums, but I am leery of where that's going. How is that going to affect us moving forward? Can we reprice those quickly enough to keep up? I don't know. I'm not bearish on multifamily, but it's one of those things that I just kind of keep a wary eye on it and go, okay, the asset has to make a lot of sense for us to buy that. Things like self-storage make a lot of sense to me because one, it's typically done well in a recessionary environment, and also because it's, again, going back to, it can be fairly quickly repriced. It's not as fast as some other assets, but you're also not limited by, Uncle Sam coming in and saying, hey guys, you can no longer charge, at least not yet, what you want or what market rates are for self-storage. So I like that. Again, the pandemic spurred some things in the boat and RV space that's been very interesting for boat and RV storage and both for RV parks. I mean, that industry has exploded. I think I'm gonna kind of make up a statistic here, but it was close to this. Year over year deliveries, 2019 to 2020, by like 3/4 of the way through the year, we're up like 35 or 40% last year. And that number is yet increased in 2021 over 2020. So we're just seeing this humongous surge in interest in RV, in travel within the United States. And so then you're going to have, where do those people park those, first of all? And then secondly, when they use them, where do you use them? Typically, you're going to stop at an RV park on vacation, or go to, if you're heading out west, you're going to go to an RV park for a few days. Or, there's obviously long-term RVers as well, but more as the recreational hobbyist. Those are people that, are going to need places to both store them and put them to use. So I see upside on that front as well. So I don't know if that makes sense or not. And there's probably some other, some more bizarre interests I have, but those are kind of the ones in the front of the mind.
Yeah, those are great comments. It makes a ton of sense. People have traveled during the pandemic, typically shorter distance. They avoided air travel, and getting an RV or getting a boat and getting away from kind of the crowds has been the trend.
Mm-hmm.
So that makes a ton of sense. The storage, my comment on the storage is I also like that asset class. We continue to invest in that. It is the beauty about self-storage. It's 1 month rent. If there's inflation, you could pass increases fairly quickly, and generally they're pretty affordable. If you were charging $100 a month, now you're going to charge 110. People not going to drag their stuff out of storage for $10 a month.
No.
So all those things make a ton of sense. Yeah, multifamily is an interesting discussion. Just providing a short comment on what you said. It is very true that some of the moratoriums, it really depends on where you're located. I mean, it comes down to what state you're in, what is the local view on who are the governments trying to please? Are they trying to please, I guess, the voters, and trying to keep things, I live in New York City. It's almost the ultimate, tenant-friendly environment, and nonetheless, rents are still climbing up, and it's kind of interesting. On the collection side, the quality of the asset matters more than depending on the locale. The collections are challenging in some locales and great in other ones, but these are great comments. Let's continue the discussion. So for commercial real estate investing, mm-hmm. your podcast is how to scale a commercial real estate investing. So let's go to the basics. How do you scale commercial real estate investing?
Yeah, and the point of the show really was to uncover those secrets. At this point, I think we've done 200 episodes in the last 6 months, or 220, whatever it is. It's up there. And the things that we have found is the basic components of the team that you organize. And that's really the fundamental is the seats on the bus, finding that team, building that team, and of course selecting your asset class, and really niching down into what you're doing. And you got your acquisitions guy. You're going to have your what are the 4 seats, Sam? I haven't slept much lately, Mike. Here we go. So you're going to have your acquisitions guy. You are going to need someone that goes out and is your capital raiser. You're going to need somebody that is really running the behind the scenes, the admin side of things. And then you're going to need an asset manager. Those are going to be the 4, basic people that you're going to need to build that team. And if you can build that team and then go out and effectively put yourself in the marketplace that you want to invest in, I think that's a great strategy to really kick things off.
It makes a lot of sense. Yeah, scaling does come with a team. If you have no team, you can't scale. You can't go buy a bunch of stuff because you have nobody to run the assets. So from that perspective, it makes a ton of sense. So this is for active investors. So you're basically saying you're a specialist. You've selected the strategy.
Right.
You believe you have. If you're a storage investor, then you have to have an acquisition expert. You got to have an asset management expert. You got to have obviously capital raising, and all those things are critical to the success of any endeavor, any project. So agreed. So besides the team, how do you find the deals? One of the primary challenges in today's environment has been acquisitions have been hard to find because of the lower interest rates. Cap rates have compressed. The basically the sellers, the distressed situations are fewer and fewer.
Right.
So it's become, mostly momentum plays, right? I mean, that's unless you can find unique distress situations. So how do you scale kind of acquisitions? Is there a silver bullet there, a good strategy?
And I can only speak from what I have done personally, and it kind of mirrors what you guys are doing in your funds, which is to go out I've been in the industry long enough that I have just excellent. I have excellent industry partners that are the operators that are doing those acquisitions, that are vetting the deals. My line is, I always say that there's already enough lines in the water, right? There's enough guys fishing in the same, or enough people fishing in the same ponds. The last thing they need is for me to go into that same pond and pick market XYZ and throw another line in the water and then just bid, for the same assets even higher. So what I've done is find key operators that I know, like, and trust. Those are the things that you have to have, and said, all right, guys, let me be, part of the general partnership. Yes, we'll bring capital. Yes, I'll bring my industry contacts. Yes, I will help you underwrite and vet some of these deals as you send them to me. And so that's how I've gone out and acquired, more acquisitions for me and my investors. For people that are more active, I mean, there's all the strategies. There's the brokers, there's direct mail, there's cold calling. I mean, those are all the kind of tried and true, more deliberate ways of finding assets. But for me, what I have found again is just finding excellent operators to work alongside that are doing that. We're seeing some stuff come across our desk that are the more portfolio acquisitions, I think, are taking place right now, where you've got some larger people selling some stuff off because they like the cap rates where they are. And yet they're still leaving some meat on the bone for some of these people. So we're seeing some unique opportunities in all the asset classes I just mentioned along that front. So yeah, when it comes to acquisitions, I mean, that's been my experience thus far. And I've done it in some other asset classes on my own, again, with the tried and true methods. But that's what I've found to be effective in today's environment.
Yeah, it makes a lot of sense. I mean, we do a lot of the similar stuff. We work with the competent operators and sort of position ourselves to be reliable providers of capital.
Right.
As a consequence, they typically reach out when they have the next deal they find. I mean, at least if they're not specialists in capital raising. And what's really fascinating, there are teams that have all of the above. Mm-hmm. And that there are organizations that are just good at one thing, identifying deals and running deals, and then I'd go with capital raising, and that's an opportunity to kind of to partner with them. But it is a good point that it is a game of specialization. Any asset class, it requires all kinds of experience and ability to execute. I think today, and feel free to provide comments, it is even more important to execute well, because a lot of these deals that you see, and it's true for multifamily, it's true for storage, it's true for pretty much anything. There's a value add strategy, and we invest into a lot of these deals. And value add, by definition, requires more work, and there's more risk associated with the value add. Now, the upside is greater, but it is predicated on the great execution. So one of the major risks today, at least what I've seen, there's a massive inflation of construction materials and labor, and the budgeting and the assumptions that some of these deals are underwritten, the numbers don't work, because they're trying to sell the deal, and they underprice the cost of the work, and then they get into the deal, and then whoops, this costs a whole lot more to complete.
Right. Yeah, absolutely. And I can't tell you the number of vetted quote unquote deals that are sent to me, and because we interact with a lot of people on a lot of fronts, and it's usually your less experienced operators that are trying to get going, that are trying to make a deal work, and they send it to you and say, hey, look, we got this under contract and we'd love your help coming in. And I turn a lot of those, I just round bend them. It's like, well, I'm really sorry, but I don't, for all the reasons you just mentioned. Like the assumptions are flawed. The rent growth is, way too high. The cost of reconstruction or remodeling the assets just too low. I haven't built in. And then the other thing I see, here's the funny one, and I was actually dealing with somebody this week on it. It's a friend of mine here in Memphis on a retail deal, actually, that we're working on. And he sent it to me, and his underwriting was so conservative. I said, you'll never sell it. So I just, he hadn't built in refinance. He hadn't built in rent bumps. He hadn't built in bringing tenants up to, cost per square foot. I was like, all right, let's go the other way. So that was kind of a fun, actually we're going to have that conversation. We hang up here is going back to the underwriting and actually bringing in what really could be a very, very still conservative underwriting and make the deal work and be appealing to investors. So, that's an unusual conversation, but to your point, yeah, the other way around is what we're seeing more often than not.
Yeah, it's a great point. You found that's a rare gem when, because they usually the operators, well, there are a few conservative breeds. I guess if it's an insider conversation with very conservative numbers versus the forward-facing numbers that the investors need to see, and it is always a tug of war between conservative underwriting, making it pretty for marketing purposes. What's really I don't want to call it fascinating, but almost aggravating, is the fact that the best marketers, they put the rosiest numbers out there, and then quite often they can perform, but they're successful at capital raising. And what's really just kind of tickles is the investors don't look at risk. They look at the top line. They look at the shiny object. The shinier it looks, the more likely they're going to invest. So if you take a deal, you underwrite conservatively, and you show IRR 16 to 18%, and then you take a deal, and then you get aggressive, you could push that number up, depending on variables. You can push it into mid-20s. It's just the game of numbers is you can get pretty creative. And that's a big challenge. As an investor, as a fund manager, I struggle from time to time to understand, is this a conservative number or this is a shiny object? And it's quite often it's not an easy exercise because there are variables, and you have to go through assumptions, and it's painful, and you're still speculating. Unfortunately, you don't know how things are going to play out. But the good news is inflation generally is kind of a tide that rises all boats, back to the boats. So.
Right. Yeah, you're absolutely right. And I think educating your investor base, whoever it is, on what that looks like. I mean, the bulk of investors, going back to the know, like, and trust comment, they know, like, and trust Mike Zlotnick, right? And they're going to trust that what you say, okay, we've underwritten this and that's great. The bulk of your investors aren't going to get into the weeds in the spreadsheet. They're not going to get into that and go, okay, and I've had a few do it, but more often than not, they don't. So they're not going to know where those hidden traps may lie in the assumptions and the underwriting. I, of course, get into every single spreadsheet and every deal we look at. I want to see all of your numbers, and I want to walk, have a Zoom call and actually walk through it and go, okay, do I like this? What have you assumed in this that maybe I haven't, that I can review and make sure it makes sense. So yeah, I think educating your investors on what those potential landmines are in the shiny object, underwriting assumptions is really, really valuable.
Yeah, you're absolutely right. And I've had this debate. What's really fascinating is that, again, back to the shiny objects, and because we manage family of funds, and when you invest in a fund, we smooth the ride for you because we invest into many projects, and you don't see the bumps down in not as much see bumps up. So the returns are smoother, more predictable. On the other side, if you go through all these projects, they're all underwritten for a bigger number. And but I had called a number of crowdfunding platforms. And they've reached out and they want to put our funds on the platforms. After the conversation, when they begin to understand we have diversified funds, they struggle. They say it's harder to sell. What people respond to, what's easier to sell, is the shiny objects. They all what's maybe this is life. What sells well is what is priced well. And my hope investors look beyond the shiny objects. It's at the end of the day that's what happens. And you can invest into 10 deals and 8 could be good and 2 bad, but if you average out, you did a whole lot worse if you did something in a more diversified manner. But anyway, let's continue the conversation. So parking lots, garages, do you see anything interesting happening there? I know it's kind of one of the things you do. What's happening there? It's kind of very old asset class. It's been around. I guess people still need to park their car somewhere. They still travel. Any kind of recent developments, where things are going, where the opportunities are?
Yeah, and this is a problem we kind of ran into in the last 2019 acquisitions became very slow and very challenging. Parking is actually a really fascinating asset class. I enjoyed it. We always said there's the 3 T's weren't there. There's no toilets, tenants, termites. If you own a service lot in a central business district, like the joke was always, what's it going to do? Flood? It's asphalt. We just wait for it to go down. Your risk is really low. Management headache oversight was very easy. You'd have an operator that you'd plug in. They'd automate everything. It was just it was a fun asset class to invest in. But what began happening is, obviously, as the economy kept heating up, people got wise to the fact that, hey, there's redevelopment potential on a lot of these surface lots. And so then the prices really just skyrocketed when it came time to buy. So underwriting became much harder to make the numbers pencil. And so our acquisitions really slowed down. And I think until we see kind of some of that pullback in the economy, I don't think we're going to see any asset prices necessarily coming down to a point where it makes sense to go back to buying. And especially when 2020 happened, what we saw was that asset net operating income on a lot of these lots and garages just fell off a cliff, but yet the prices remained the same, which then it just turned underwriting completely. It was just not possible. You couldn't get funding on it. But no bank could look at something that just really wasn't, stuff that we were offering millions and millions of dollars for, 6 months before, suddenly wasn't even covering taxes, which is just, that's not where we want to be.
Well,
we're not spec land buyers. So
well, that's the COVID dislocation, I assume. Now, as we're coming out of COVID, just curious if you see the trend coming back, or
yes,
what you mentioned, the primary challenge becomes highest and best use, no longer a parking lot or parking. Maybe you could build a parking structure, but then the question is it more economical to build a parking structure or build something else in that location?
Yeah, and most of the time it's build something else, just both from a tax, a city tax revenue perspective, and also, like you said, for highest and best use. I am seeing it come back. There are opportunities that are starting to present themselves. Obviously it's going to be in the states that opened up the soonest. Looking in Florida and Texas and places like that, we are seeing, some of that start to turn a corner. I love parking as an asset class. It's great when it's producing an income. Like I said, it's easy to manage. It's a great covered land play if you have the right size and shape of lot. I mean, it's an excellent way to produce a very passive income, and then always have the potential to redevelop it to something else. So yeah, we're seeing that come back, but it's still not at a point for us at this point where we're ready to jump back in with both feet and go back to buying, or even can. That's what we really ran into. It's not that we thought it was necessarily a terrible idea. We just couldn't do it because you just couldn't underwrite it. And again, we're only going to buy things that actually produce an income. So that's kind of one of our guiding principles. And if it doesn't, then we're not going to buy it. So that's the end of it.
Yeah, it makes a lot of sense. You're a value investor. You're not a kind of a growth investor taking a lot of risks with the upside. Makes a lot of sense. The other question that I had is, I guess I don't know if you're seeing this at all. So you have some history and a track record with buying at auctions, but now I guess that whole aspect of acquisition strategy is pretty limited, right? I mean, most of the auction sales haven't taken place. Residential, because of foreclosures, haven't been driving, so no auctions. And then I don't know if you have any commercial auctions. You seeing anything happening, or?
I am watching the commercial auction side of things. There's been some interesting stuff that I haven't tracked as well as I probably should. Just some interesting things that are shaking out. And I think we're going to see more of that actually in the future when moratoriums lift, when the pain of the, lockdowns and things actually begin to be felt. I think that will turn, that'll turn on its head, and we'll actually see a lot more of that. Right now, like you said, not a lot of opportunity, especially on the single family side. We used to buy a ton at the courthouse auctions for single family houses. And the hedge funds got wise to that. They started coming into town. And so then there was just humongous institutional money coming into at least there were here in Shelby County, and really across Tennessee. And so we started competing with them, which we couldn't because I don't have hundreds of millions, in my pocket to buy at the foreclosure auctions. And they could pay up. They could afford to pay more for assets that had tighter margins than what I, as the small investor, could. So that we did also put. It's a great strategy. I loved buying at auctions. It was great. I mean, there's it's fraught with risk, but also fraught with great reward. So it that was something that was a lot of fun. I think we're going to see. I think, and I could be wrong. I don't wish for it, to be honest. I mean, it's not good. It's not good when everybody's losing their house, when people are getting foreclosed on, when that's just not a sign of great things. But it's also just part of what we what needs to happen. So.
Yeah, the natural selection laws no longer play because the government is interfering, and to a degree, that moratorium on foreclosures have caused massive inflation because you remove distressed inventory completely. Right. You remove distressed inventory, you got effectively very limited supply. You have no distress supply. As distress supply disappears, only performing supply, and then the supply and demand is badly disbalanced.
Right.
So we'll see where it goes from here, but auctions are a vital part of the system, and from one point of view, I don't want people to lose their houses. On the other side, if these properties are badly behind and no payments have been made, then they need to go through the process. If they don't go through the process, it becomes, I don't know, what do you call it? It becomes you as a lender or you as an investor, cannot participate in the in repositioning of a distressed asset. In some ways, it's a shame for the neighborhood, and it needs that. But so appreciate all your wisdom, and any kind of parting thoughts. We were almost out of time. Any great nuggets on or how would people contact you if they want to learn more about SAM and maybe look to invest in a parking garage or something?
Yeah,
when they become available.
Right. Yeah. Well, and they are available. I know some people in the business that just closed a great garage, and it's like it was a deal that made sense. So there's opportunity out there. I'm not saying there's anybody that says there's never opportunity isn't looking hard enough. So the great best way to get a hold of me, you can email me, Sam at Bricken, BRICKEN investmentgroup.com. On our website, you can go to brickeninvestmentgroup.com/checklist. There is a great guide that we've put together, which is how to vet a deal in 10 minutes. It's a checklist that I actually use myself because I found that I could spend incredible amounts of time looking at the wrong deals that didn't necessarily fit my buy box, and somehow you're like, but maybe, I wonder if, and then an hour and a half later, you're like, no, that's probably not the right one. So I've really got a guide that helps you narrow that down to about a 10-minute, you can spend 10 minutes looking at a deal and help you figure out if, hey, is this something to investigate further, or do I throw this out? So look that up, brickeninvestmentgroup.com/checklist. Otherwise, shoot me an email, and I'm happy to respond as fast as I can. Yeah, I appreciate that. That's actually a great nugget, because if you are looking to buy, you got to have your goals and your bucks and what are you looking for. If you don't know what are you looking for, well, you don't know where you're going, how are you going to know you got there? Right? A lot of people look at deals that have no idea what they're looking for. Right. So how does that fit? It's a bright and shiny object. It may be a phenomenal deal, but it doesn't fit your strategy. Right. I have that conversation almost every day or a few times a week when people call and they want to invest, and then they go through a family of funds. At least we just give them Tempo Opportunity, Tempo Growth, two basic choices, and they don't know what they want. So how do they choose? Right. Hopefully you have your own internal plan. What are you doing with IRA money? What are you doing with the non-IRA money? What kind of assets would be comfortable for you to invest in? Are you looking for a little bit more investment grade, more conservative investing versus a little more speculative where you can make a little higher return? If you knew at least some basics of it, you could do a lot better selecting deals, because otherwise you just don't know where you're going. So yeah, and investors get so overwhelmed too. I mean, you're looking at, do I do this? Do I do that? And then, 7 weeks have passed and you've looked at how many countless deals and you're still not sure what you're doing with it. It's a very frustrating, especially if you're first starting out. Once you get some traction, it becomes easier. But yeah, when you're first starting out, it's really, it can be information and just processing overload. So that'll help you, hopefully some of your listeners help them kind of narrow that down and become an easier process.
Yeah, thanks for the checklist. It's worth having a checklist. And I do want to say also it's important to have a plan. Most people don't even have a plan.
Right.
My father taught me you got to have a plan. If you don't have a plan, it's a lot worse than having a bad plan, at least starting with a plan and then being able to change it. Because if you have no plan, I mean, you're planning to fail. Right. Saying failure to plan is planning to fail. So
you got it.
Sam, thank you for your wisdom. Again, BrakenInvestmentGroup.com. That's the way to find you. I appreciate you coming on the podcast, and let's talk again soon.
Sounds great. Thank you, Mike. Appreciate it.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike Zlotnick. Keep listening and keep investing Big Mike style. See you on the next episode.